Good morning. My name is Dr. Mike Deliberto. I'm an agricultural economist with the LSU AgCenter. I'm in Baton Rouge. A majority of my research and extension work involves rice, sugarcane, cotton, and soybean market economics and policy. It's a pleasure to join you today virtually, and I'm going to go through a little bit of the current supply and demand situation for rice and soybeans. As I join you virtually today, a few disclaimers. The information contained in this report is effective the week of December 14th through the 18th. Information is obtained from the latest USDA reports. At any point in time during the new year, you can access our rice production economics decision tools and commodity budgets, as well as our monthly market reports and quarterly ag policy newsletters, and anything and everything rice economics related. And I've put those links in the presentation today. For the presentation today, I'd like to talk first about the rice market, then the soybean market complex, transition into our rice production cost and returns for 2021, and that's going to involve talking a little bit about the competitiveness of rice in the new year, as well as some of the projected cost and returns for competing enterprises, and then I'll conclude with an overview of some notable Farm Bill program changes to the ARC and PLC as they pertain to the 2021 crop year. This first slide demonstrates or illustrates the U.S. total rice production. I've provided the previous 5 years. Those are in those darker green bars you see. First and foremost, the U.S. had about a 510,000 acre increase in production. That contributed to about a 22% larger production crop than we had the year prior. USDA estimates the 2020 rice crop at 226 million hundredweights. Again, that's 22% larger than the relatively shorter, smaller crop that we had last year. A few things contributed to this. Yes, it was an increase in harvested rice area, but also the strong rice prices in the 19 year contributed to a larger crop. You combine that with favorable growing conditions that we had early in the season, and that was despite having impact and infrastructure damage from the hurricanes that hit South Louisiana in the latter part of the fall, causing problems through North Louisiana and even delaying the rice harvest in Arkansas. Third, U.S. rice yields were over 7,500 pounds this year, and that equates to about a 90-pound production increase year over year. So again, those three things combining factors that give us a larger crop in 2020. This next slide talks about rice harvested acres. I went back 5 years and thought it'd be interesting to look at where the 2020 crop compares to the 2019 crop. That gray bar you see on the screen, that is the 2016 to 2018 average harvested acres by state. The gold bar is the 2019 harvest area, and the purple bar is the 2020 harvested areas. And I've denoted the year-over-year acreage increases, notably for Arkansas, that 315,000 acre year-over-year increase. That state accounted for about 61% of that total area expansion that we had in 2020. Louisiana rice acres were up as well as rice area in all 6 rice-producing states. Looking ahead, Arkansas does expect their rice acres to be down slightly, anywhere between 90,000 and 100,000 acre reduction. A majority of that is going to come at the expense of long grain acres. They do see a little bit of an increase in medium short grain acres, so I think total acres in Arkansas planted next year would be about 1.35 million. That's what their specialists are saying at the Rice Outlook Conference earlier this month. In talking with Dr. Harrell and Dr. Levy at the AgCenter, they expect rice acres in Louisiana to increase between 10 and 15,000 acres, so that should put us close to 480 or 485,000 acres of rice for next year. So transitioning this on a supply and use balance sheet, or kind of putting this in a tabular format, the first thing I want to talk about is the ending stocks. If you look at that purple bar on your left, you could see that our ending stocks last year were 28.7 million hundredweight. So we started this marketing year in a relatively tight supply situation, so that gave a lot of price momentum early in this marketing year because our beginning stocks, or what we carried in from the previous marketing year, was about 36% less than what we had when we went from 18 into 19. One thing I want to talk about a little bit is the production. We've talked about that area expansion being about 22% higher, but imports. Imports are fractionally down from last year levels, and that is because last year was a record. We imported a lot of rice on the long grain side from Thailand and India. That was the basmati and the jasmine rice. USDA does expect to see those monthly shipments from Asia to persist for a majority of the marketing year. However, they have total imports slightly down from where we were prior. So the net effect of that on the supply side of the balance sheet is that we see about a 9% increase in total rice supplies year over year. The good news, when we move down into the demand components, we see an increase in domestic use year over year, and we do see an increase of about 1% in rice exports. A lot of that was at the long grain sector. We do see about a 4% increase in long grain rice exports. The slow pace of exports earlier in the marketing year, I think, has entered into the minds at USDA. They've backed off the export forecast slightly, but I think that can be contributed to a little bit of the logistical disruptions in the supply chains from those hurricanes and from those perhaps delayed shipments to core buyers in Haiti, Latin America, Mexico shipments, etc. And I'll talk a little bit about exports by class later in the presentation. Nevertheless, total use is up year over year. Ending stocks, the all rice ending stocks are up 77%. And when we talk about tightness in a market, it just doesn't apply to this last line in the balance sheet. In contrast to where we were last year, we do have a higher level of carryout, and that's one thing that could limit the upside potential in this rice market. And you see that when the stocks to use ratio went from 12% last year to upwards of 21% this year. By class, here's an illustration of the long grain production. Again, major production increase from Arkansas. Yields were up in every state except Texas. So we saw a 35% larger crop. USDA has the long grain crop at close to 170 million hundredweights. That's up from about 126 that they had last year. Again, same methodology when we look at the long grain supply and use balance sheet. We see that tightness in the market. The ending stocks in 1920 at 16.9 million hundredweight. We carried that over into the new marketing year. Our ending stocks are down almost 49%. And that's the lowest ending stocks that we've started a long grain marketing year since the 2004 crop year. So again, tightness is very evident in the market. It did support prices early on. I talked about that increase in production from expanded area. So the net effect is a 15% increase in the amount of long grain rice supply that's projected for the 2020-2021 crop year. Use is up 4%. Use tends to track with supply. Long grain exports are up almost 4%. That 67 million hundredweight, to put that into a little bit of perspective, in the November WASDE report, USDA had that number at 69 million hundredweight. They backed off of that about 2 million hundredweight. Again, I think that's more contributed to some of the logistical disruptions we're seeing with the pace of exports early in the marketing year in the month of August and September. However, the pace of export sales has increased over the past 3 or 4 weeks. This past Thursday, which would have been the 17th, was a very, very strong weekly sales report for rice. So we're starting to see that pace of exports pick up, which is very encouraging to alleviate some of that carryout. The increase in export is also the result of a larger crop. Larger crops signal more competitive prices, especially competitive prices against our competitors down in South America to compete for market share. The ending stocks, again, 126% over, so we went from 16.9%, call it 17, to over 38 million hundredweight to end this marketing year. So that brought our stocks to use ratio from 9.9%, which was abnormally a pretty tight marketing year, to upwards of 21.5%. Typically, those act inversely to price. When we see rises in ending stocks and rises in that stocks to use ratio, it does limit price movement and it can hinder upside price. That's why USDA has the season average farm price for long grain estimated at $11.80 a hundredweight or $19.12 a barrel. That would be the largest ending stock since 1985. With the medium grain supply and use, I did want to say that we had a smaller production this year. Production on the medium short grain side of the balance sheet was down a little over 4%. at 56.3 million hundredweight. Use was down slightly. Again, those are going to track generally with supply. We do see a slight reduction in exports year over year, and I think that's contributed to those few sales that we make outside of those WTO commitment markets, Taiwan, South Korea, and Japan. The ending stocks is up. But when you look at that season average price, USDA actually has a higher season average price. So again, that's acting kind of in contradiction to what that economic theory would tell us when those rising ending stocks and rising surplus on the market. And I think that's attributed to that decrease that we had in production. There's also some weather concerns in California right now with the amount of snowfall. So that'll be interesting to watch. Buyers did get a little bit aggressive to supplement some inventories over the past couple weeks in the short medium grain market. I think the weather will turn a little bit more favorable to them going forward. So that would be something to watch in terms of how those southern and medium grain, how those prices overall change as we head into planting season. This slide highlights long grain rough rice exports. The red line is the current year. The blue line is the previous year, and that green line is the 5-year average. This is USDA and census data, and you can see that red line was hovering fairly low for the first 3 months of the marketing year. That pace of sales, again, attributed to logistical disruptions in the supply chain, slower pace of sales to Latin America and Haiti. I think that was some concern that we weren't moving enough rice early in the marketing year at higher quantities, but I think those concerns have been alleviated when you see that pretty sharp increase in export sales over the past couple weeks. Very encouraging for the rough rice market. This next slide looks at rice prices by class, and I've gone back the four plus marketing years just to show you the monthly reported price by USDA. But I've talked about tightness in a long grain market, and in that blue line in the 1920 marketing year, you can see a consistent movement month over month over month in the appreciation of that long grain price to $12 where it closed out last marketing year. And you're starting to see kind of an appreciation of that southern medium grain price as well, since production was down from the year prior. I don't talk a lot about rough rice futures. It is a thinly traded market, but I thought these two graphs were interesting and were relevant to the discussion at hand. When I put this presentation together earlier this week, so that would have been December 14th, that January 21 contract, it was sideways. They had pretty well-defined support at 12.23 a hundredweight. That resistance at 12.45, 12.48 a hundredweight seemed to be a pretty tall wall for that price to get over. So I think the market was really searching for a direction. How was it going to process a short crop combined with an expansion in the 2020 marketing year with that increase of production? Exports, the pace of export sales was concerning, but just yesterday the market closed at 12.58 a hundredweight. So again, it broke through where it had been for the past 3 weeks. I think that's encouraging. Strong sales. We did see some technical buying. The market, much like other commodities, gained support outside. So we did exceed those resistance and that resistance level at 12.48 as we climb higher in the market. Again, that bigger crop, the higher ending stocks, I think that could be the biggest factor right now to limit that upside potential going forward. That chart on the lower right-hand side of the screen is just the weekly continuous. That really kind of captures the past 3 years of the rice contracts. Again, we're a long way from where we were this past summer when the rice was, $22, $23 a hundredweight, and that was a lot of spets and just a shorter crop on hand. This next slide is just from futures where they closed Wednesday. I've put the 10-day moving average in there as well. That's the green line at 12.35 and the 50-day moving average, the orange line, again capturing some higher prices in history at 12.42 a hundredweight. Again, the market broke 12.50 just the other day. Strong technical buying, strong market support, bullish export sales data, and that was actually combined with about a 97,000 ton sale we made to Venezuela, something we haven't done in a while. So putting that all together, putting a bow on the 1920 marketing year, we started with tight supplies. We did see increased acreage not only in Louisiana but in every rice-producing state. The COVID-19 pandemic, the supply chain disruptions, it did create an impact on the market. The panic buying, the hoarding, if you will, I think that is underpinning the domestic and maybe the global market to an extent, but I don't think it's doing it that there's a shortage that's going to be imminent as well. But you can't talk about the previous marketing year without talking a little bit about the effect that COVID-19 had, especially on the supply chain, especially on exportable supplies, especially coming out of Asia, as well as some of our competitors in South America. Strong demand both domestically and globally for rice is helping price right now. It's helping us move a larger crop. Rice was shipped to China last year. It was unloaded at the end of October. Rice sales to China would be huge, but I don't think we're definitely seeing enough in a move of that direction to put them in as a consistent buyer. And of course, the adverse weather at harvest, not only for southern Louisiana, northern Louisiana, and into Arkansas, with the impact that had on crop quality, the ratoon crop and harvest operations, and the rice infrastructure in the state. Going forward, 2021, there's a steady undertone in the market right now. I don't think we're seeing enough trading pressuring prices that much to move it higher. New crop futures right now, especially for a September contract, are sideways. The pace of export sales is something to watch. That can certainly change. We've been making sales to Brazil, which hasn't been a typical buyer of long grain rice, but they're in a supply situation. They have super high inflation right there. And sales to Iraq would go a long way at giving those mills a lot of business post-February when their schedule kind of opens up a little bit. Iraqi grain board is supposed to flow to tender soon. That's been the talk of the trade for about the past month or so. How will they finance it? There's a lot of interest on what they may do going forward. We saw some border trade in South America right now, but Brazil isn't the only country down there that's got a tight supply situation. You can apply that to Uruguay, Paraguay, Argentina as well. Brazil's going to expand production next year, but only about 5%. So I think Brazil needing rice imports is going to be pretty imperative, at least into the spring when their harvest comes online. And this next slide here just shows you the pace of Brazilian exports. Their currency has declined about 30% since the start of the year. They were able to take advantages on some early pricing opportunities that they had. It gave their growers a little bit more profitability, but it created a really tight supply situation, not only in their country, but other countries as well. So again, a non-traditional buyer like Brazil has come to the U.S. in search of competitively priced exports, and we have about 200,000 metric tons of sales on the books to Brazil for this year. This next slide just talks about the FOB long grain export prices. That red line at the top is the U.S. Long grain price. You could see it's came down a little bit with the culmination of harvest. That dotted purple line is the Uruguay price, out of South America. That tightness of their crop, you can really see it start to accelerate the prices that they were charging. That black line is Thailand. The gold line is Vietnam. We saw a little bit of an inversion there. Vietnam was capitalized early on some sales to China and some neighboring border trade there. Their prices were really uncompetitive at those high levels. That's why you see the Vietnam price go down. Thailand price has come back up, so you saw that inversion happen there. An appreciation in the Thailand currency certainly didn't help their exports. But that green line at the bottom is the Indian export price. India is the major global player in rice exports. They have a lot of rice. They have a lot of rice that they're ready to export, and they have very favorable prices to do it. This slide really just talks about the abundance that India has in terms of exportable rice. Another year over year. Technically, it's not a growth, but that's a lot of rice that they can put on the world market. You do see a rebound in Thailand. They had a reduced second crop. They had some higher prices early. I think they're going to rebound, get a little bit of that Southeast Asian market share back to the country. But simply put, India is the major player in the rice export market. And I saw last week, I think Reuters reported that China actually bought rice from India for the first time in 30 years. Switching over and talking about soybeans now, This graph just looks at the previous short production history of soybeans. Soybean production is up 17% from 19 to 20, and that's on expanded harvested area, about 7.5 million harvested acres, but also on yield. U.S. soybean average yields went from about 47.5 bushels to 50.7 bushels in the latest USDA report. And oftentimes, a lot of people in the trade, a lot of the people in the press, they'll get hung up on soybean yield. And, every half a bushel you add to soybean yield can add almost 2% to total production. So a half a bushel here, a half a bushel there on, 80 plus million acres can definitely impact the balance sheet. 2019-2020 was a short crop. We had a record 4.5 million acres of prevent plant. So we saw that rebound happen. Next year, there could be as many as 91 million planted acres for soybeans. So it'll be really interesting to see what the Midwest does with those guys that grow soybeans in rotations with corn. The corn-soybean price ratio, a lot of people use that as a barometric to gauge, to kind of understand where soybean acres might go. And the way November soybeans and December corn are behaving right now, it's telling producers, plant soybeans, plant soybeans, plant soybeans. This shot of the supply and use balance sheet for soybeans, again, we had a tight marketing year last year, 525 million bushels. We carried that over, so we started the year with less soybeans in the pipeline. We did see that increase in production, hence supply was increased. But the export component of this, crushings and exports have been the bright spots for soybeans. Crushings, the National Oilseed Processors Association, they reported record crush not only in the month of October. I think that was the highest month ever. You had strong reportings last week for their November estimate. So again, that's fueling the fire and fueling the momentum for the strong demand we're seeing. Exports are up 31%. We've gone from 1.6 billion to 2.2 billion, and a lot of that is because of China. Year-over-year increases to Chinese commitments have been really strong. We've had a lot of front-loaded sales with our soybean exports, so that's helping alleviate a larger supply situation. Supply is up 5%, but use is up almost 15%. So that tells us that the market is willingly and able to move a lot of soybeans early in the marketing year. Our ending stocks at 175 million bushels are a far cry from where they were last year. We're down almost 48%. And depending upon the trade, 130, 140 million bushels is kind of the minimum that we need in the pipeline to ensure prices stay between that $10 and $11 mark there. But that would be the lowest stocks to use ratio at 3.9% that we've had since 2014. In 2014, we ended with a little less than 100 million bushels in the pipe or ending stocks, and then prices peaked at over $15 a bushel that year. So that does put it in perspective. I put this slide in. The brown bars denote our production levels, and that purple line is the ending stocks. And I thought this was interesting. I started in May 2020. The May estimate was the first time that USDA actually estimates the new crop. And you could see that up until August, they thought ending stocks were going to grow. We saw a weather event in August in the Midwest. It dampened production. It reduced the yield. And then since then, we've combined a smaller crop with increased crush, increased exports. So USDA not only has dropped production down, but that accelerated crush, that accelerated exports that we're seeing, it's really dropping those ending stocks down, and that's been a catalyst behind the recent gains in the soybean market. These graphs on your left just illustrate where our ending stocks were. You could tell we're well below the 5-year average, way shorter than where we were the past couple years ago. But the graph on your right, and that neon green line is the U.S. stocks to use ratio at 4%. When you look at where the U.S., Brazil, and Argentina is, it's down there at 17%, and the world is 20%. All that means is there's a tight supply situation, not only in the U.S., but also globally. The export sales for our to all world partners have increased. That's the red line on the graph. That bottom graph is China. Those are accumulated exports to China. China makes up about 73% of all export shipments to date and 57% of all commitments. Now, that red line is way higher than where it was the past couple years. It's definitely over the 5-year average. I wouldn't be surprised to see the pace of those sales back off a little bit in the market. Typically this time of year, buyers will switch to a South American crop, which should go online in January. So it may not be all that out of the ballpark for some of those China to roll some of those commitments away from the U.S. and into Brazil. But weather concerns in South America right now, they may hinder that a little bit, but I wouldn't be surprised if some of those sales get off of our books and move to Brazil. But fact of the matter is, commitments to China year over year are 200% higher than where they were last year. So we're definitely kind of competing in that 2016, 2017 area. This next slide just shows soybean exports to China. This is outstanding sales and shipments combined, and you can see we're well over 1.1 billion bushels to the Asian nation. Way higher than we were the past 2 years since we're in this trade spat with China. It's fairly comparable to where we were, not quite in 2016 and 2017, but where our exports were. A lot of attention is talked about with the Phase 1 agreement. This graph was obtained from the American Farm Bureau Federation. The Phase 1 agreement between the U.S. and China stipulates that China will import about $36.5 billion in agricultural goods in the calendar year 2020. For the month of October, that's the red line there. You could see $17 billion. That's up from $12.5 billion in September, which is good news. The bad news is that we're still not at the pace that we need to meet that Phase 1 agreement right there. So with all this encouraging signs that you see coming out of China, the pace of sales has been good. Their appetite for not only U.S. soybeans, but U.S. corn, U.S. sorghum, and U.S. cotton have been well. This is something to keep an eye on in terms of reaching those overall commitments and what this may mean for future negotiations. This is historical soybean prices. This is the monthly seasonal average price received by farmers. And you can see in 1920, those strong demand, strong crush, strong exports, tight stocks have really moved that price up. The October price was $9.63. I look for that price to go higher now as a lot of these sales were front-loaded into the marketing year. This slide is the January futures closed on Wednesday, December 16th. You can see that it closed at $11.89. The 10-day moving average, $11.32. The 50-day moving average, $11.63. But you can tell fundamentally right there, Brazilian weather has improved a little bit. They're expected to get a little bit more rain, improve their soil moisture going down. But traders have also gotten out of some of their long positions to take profits out of the market. So when we talk about maybe some of that technical buying pressure, that's where it's coming from. But I think behind the scenes with soybeans right now, the soybean meal exports, the soybean oil exports have really kind of been the catalyst behind the scenes. Yes, we've had a tight crop. China is buying soybeans, but port strikes in Argentina, the workers there went on strike, the inspectors went on strike. That does allow us to maybe be in a position to capture more exports in the soy meal area from other buyers. But demand does not appear to be reduced due to these higher prices. It's been a while since I was able to show a slide like this, but the current futures, the nearbys, settled above $12 for the first time since 2014. They settled, I want to say $12.01, $12.02. The next resistance level for this event is going to be about $12.08, $12.10 a bushel. So again, you can see every time the soybeans clear that $9, $10, $11 mark, there is a little dip in prices. But again, fundamentally, the market is supported. We've seen a lot of front-loaded sales. We've seen a tight crop. So collectively, this is where those supply and use dynamics are starting to appear in the balance sheet. Now, we'll say this, that market sentiment always follows price, right? When the market rallies, it's a bull market. When that rally stops, is it a bear market? And that's when some of this, you've heard it so much on the news, that media bias kind of comes in there to play. So I would just say be careful what you read in the press right there and kind of think about market sentiment and prices. My research associate Brian Hilbin and I in the department, we're charged every year with projecting the cost and returns for not only rice but 7 other enterprises that are produced in Louisiana. In surveying input suppliers for the 2021 crop year, this slide breaks down the fuel price and the fertilizer price. Diesel is $1.73 per gallon. That's farm grade diesel. Nitrogen price per pound per active ingredient is 38 cents. Big reduction from the 2020 crop year. Reductions in these two components can translate into overall reduction in the total direct cost per acre because a crop like rice is very energy intensive in terms of its irrigation and fertilizer needs. This next slide just looks at the Clearfield production systems on a drill plant system. We estimate on average Clearfield drill planted cost to be close to $500 an acre in 2021 for Louisiana, and this slide just breaks down all the direct input units from drying, hauling, chemical, seed, fertilizer, etc. And I've just highlighted the fuel and fertilizer share of the budgets. Something that we've started doing is looking at the competability of rice. I know this slide is rather busy in this table, but these are the budgets we do for all the crops in Louisiana. Absent from this would be sugarcane. But what I've done is I've taken the total variable cost for each of the crops in that first row. I've looked at the total fixed cost, the total cost, and looked at some projected yields for new crop. In that orange section in the middle, we've looked at conventional rice yielding 6,500 weight an acre, Clearfield rice it's 7,000 weight an acre, and hybrid rice yielding about 8,000 weight an acre. We've put those in relation to how much does it cost to produce those crops, not only from a total direct cost, but from a fixed cost as well. And what I've done in bold is estimated the break-even price that a grower would need to receive to cover the direct cost of operation as well as the fixed cost on a per acre basis. And you could see that I'll just pick out Clearfield rice here, between $720 and $850 to cover your direct or to cover your total cost. And if you look at where the market is and you put a conservative estimate right there at $12 in the market, rice is profitable. It can outcompete soybeans, so I think that's why you're seeing not only an interest in rice in Louisiana with the furrow irrigated systems up north, look for an acre expansion in Rapides, Avoyelles, Catahoula, Concordia, and the Tensas Parish as well. And I think the competability with soybeans in Arkansas may be something to watch as well. And I know I'm kind of jumping from state to state here, but over 50% of Arkansas's rice acres are rotated with soybeans. We have this information available if you'd like it to see how this affects different rental arrangements. Please send me an email. I'll put my contact information out there as well. But this is the type of production information and analysis that we put out in our budgets that will be posted on January 4th, and it will be sent out to all the county agents. This next slide just takes a $12 rice price and talks about the break-even yield that you'll need to cover your conventional Clearfield and hybrid costs. For instance, it's going to take almost 5,000 pounds an acre to cover your direct cost of production with Clearfield rice. Again, higher market prices, a reduction in the overall production cost of that crop do signal into a lower break-even yield that you need to achieve, signaling the potential for higher margins. New crop comparison, this just kind of takes that analysis one step farther and looks at the returns. And you can see this is at $12 rice. Again, this is the type of analysis we do in our budgets, not only for conventional, we do it for Clearfield and we do it for hybrid rice for the Southwest as well as the Northeast region. But, oftentimes those budgets, those PDF files, it's black and white. It's just a representative approach. It's the average cost with an average number of herbicide treatments, average number of fungicide treatments, etc. Growers can download this 2020 cash flow tool, and this will allow them to estimate the cost of their operation, their break-even analysis, not only on a farm-by-farm, but a tract-by-tract basis. Growers can go in, put in their projected acres, yield, market price parameters, fuel parameters, chemical parameters, and it'll calculate gross income. As you move farther down the list, you can specify all your other variable production costs, and it can calculate your net returns above variable costs and net returns above total cost. We will post this on the Rice Crops webpage, as well as send a copy of this Excel decision tool to all the county agents working in rice. Another decision tool we have, it's a little bit of a condensed version of what I just showed you. It's our rental arrangement decision tool. Growers can go in, they can enter in their farm program yield, expected PLC payment, their production cost, and it shows them over what prices of combinations of prices and yields, where would their return levels be under different rental arrangements that they can go in and specify. Again, this is done not only for the grower but also for the landowner as well, and this is a Microsoft Excel tool that we will post to the website. A few notes on just ARC PLC. If you recall, producers elected ARC or PLC for covered commodities for the 19 and the 20 crop year. Well, effective the 2021 crop year, that ARC PLC decision can now be made on an annual basis. So between now and March 15th, you can go in, you could sign up, and you can make your election for the 2021 crop year at the FSA office. This slide just breaks down the projected 2020 PLC payment rates for rice. The long grain PLC payment rates projected at $2.20 a hundredweight, and the medium grain price is projected at a $2 per hundredweight PLC payment, with these payments being made after October 1st, 2021. We also develop ARC PLC tools. If you have soybean base, wheat base on your farm, we will release these at the first of the year. It compares these different program options under different ranges of prices and yield. We have this available for almost 22 parishes on a crop-by-crop basis, and I put those crops on your screen right there. They're available for download. We'd be happy to send these out to the agents as well. And I also do a monthly crop market newsletter for corn, soybeans, rice, and cotton, as well as a quarterly ad policy newsletter. These are free. We've got our distribution list to 370 individuals now. If you'd like to sign up, just email your agent or email me directly. I can't thank the Louisiana Rice Research Board enough for their support and their funding, along with the American Sugarcane League, Cotton Incorporated, Louisiana Soybean and Feed Grain Research and Promotion Board, as well as organizations like Farm Bureau and the Louisiana Cotton and Grain Association for their support and research funding over the years. Here's my contact information. If you have a question on anything we've covered today, any of these farm management decision tools, please feel free to email, call Jeremy, call your county agent. I'd be more than happy to come out, sit down, talk about these tools, and answer any questions you may have, and look forward to working with y'all in the new year.